Hello, everybody, and we're almost to the new year, so I suppose I can say, Happy New Year's. Hope the new year was, or the old year, 2024, was good for everyone. For me, it was significantly better compared to 2023 when I had a bunch of brain surgeries and spent a bunch of time in the hospital. This year wasn't so bad. This actually ended up being one of my better years in terms of investing. And I've had a lot of conversations with people about investing, and I don't really feel like I've given it the time and opportunity to really discuss things at length with them, in sort of an organized, structured fashion, so that I'm remembering things and I'm telling them things and what have you. And again, I'm having these conversations sort of one off, with this person and then this person. I'm not really um, binding all this together in sort of a really good structured conversation. And what that does is that means that if I'm feeling pretty good on one day, and I'm really thinking about all the things that I need to talk about when I'm giving someone a rundown on some of this stuff, they may get a much better rundown than somebody else who catches me on a bad day where maybe I didn't get enough sleep and I'm just not really thinking of everything. So again, by doing this in a video, the beauty is it's sort of locked into a video. It's structured as the video allows for. My performance there can then be shared with a multitude of people uniformly. Obviously, everyone's watching the same video, so yeah, that's handy. It's a handy thing about these videos is they're great vehicles for knowledge transfer. So what I wanted to do is, since this was such a great year for me, I did want to kind of share some, just kind of start with a part one, kind of a simplified approach, and then do multiple, increasing complexities. Like anything, you have to build kind of your basic things. You have to kind of start to understand how to talk some of the investing game. Now, again, I'm not an investor full time. This is something I do on the side. I don't even day trade. I just kind of pay attention to things, make moves, as it makes sense. I'm a software engineer full time. That's what I do. Is I build applications. I don't really focus too crazily on these sort of things. So things like getting into market research, products, and things like that. The aspect, and that is actually probably the first term we should talk about that I didn't actually put here, and we'll just go ahead and throw it on there. Speculative investing, because that is really what this is, right? This is speculative investing. So obviously the word speculative is key there, and we'll kind of talk about that here in a minute. So to kind of show, just so I'm not talking out of my booty cheeks here about what I've succeeded. What I'm going to do is I'm going to turn off this display in OBS, which obviously is going to make it very pretty. And I'm just going to show my screen here. Um, you can see my positions and what have you. But, here's my year to date. My year to date is just shy of 71 grand. Um, so this is my Robinhood account. I've had similar returns like this in my E-Trade account. And I can kind of get in a little deeper into my particular investment strategy, which I've changed it quite a bit over the years, and I kind of like where I'm at right now. Could be better, could be worse. Again, none of the stuff that I'm going to talk about is going to be a get rich quick scheme. Those do exist, but they're similar to like the lottery, right? You can get rich winning a lottery. I've heard of people that's their retirement strategy. Their retirement strategy is to take the money that would normally go towards a long term retirement fund or something to that equivalent, and they go buy scratch offs, or they go buy money balls, power balls, and in their mind they think if they're spending a couple $100 every month on this times 30 years, eventually they're going to hit it, right? And that's an interesting take. I'm not sure if they've actually worked the numbers to see what's the probability that that's actually going to happen, but let's just say that's not something I would ever do. Um, anyways, so yeah, what we'll do is we'll kind of go through this at a basic level. We'll kind of top to bottom this how I sort of wrote this out, and yeah, we'll go from there. So obviously, the first thing I want to do is talk about terms. And I'm not going to spend too much time on these because I think each of these we'll sort of talk about more in depth as we get to the relevance to investing. But you'll hear these terms get thrown around a lot in the investing world. Some platforms don't really use certain things. So, for instance, like a wash sale, you won't really find that on Robinhood. Robinhood doesn't really mention that. They sort of do this back end magic where this isn't something you ever really have to necessarily worry about. It's still kind of there because it's, as I'll explain, it's part of legal requirements, but they work the liquidity in a way where it's less relevant to somewhere like E-Trades, where it's much more forthright in your portfolio management. So that's something you would have to keep track of. So anyways, let's run this top to bottom. Speculative investing. So again, that's kind of what we're doing here, right? You're speculating. You're basically looking at something and you're thinking, does it go up or does it go down, right? You can make money on both ends. There are a lot of people that make money when a position goes down. A lot of people make money when positions go up. The go up is very simple, right? Like that's the most basic thing I think all of us sort of understand when it comes to investing. Where it gets really kind of convoluted is when you start making money off of something that's losing money, and we'll get into that a little bit in depth. The next two terms is retail and institutional investors. So this is kind of confusing because I know when I first started, I heard retail investor. I thought, okay, a retail store. So what is this? Is this a business that's investing? No, when they're saying retail investors, they're sort of talking about you as a retail consumer, right? So if I have a product and I sell the product to a business, that's a business customer. If I'm selling it to a non-business customer, just a regular old Joe, that would be a retail, right? So it's still the same thing here, right? Retail is just your regular Joe's, just you, me, and the cat. Hopefully your cat's not investing. I don't know. Maybe they know what they're doing. Anyways, so the next one's going to be institutional investor. So an institutional investor, that is going to be your actual organizations. Most commonly, that's going to be your things like hedge funds, right? That's where most people are going to think of. These guys here have an asymmetrical amount of power in the market, and we'll talk about why that is. Just a couple brief things as to why. They can do things like 10x margins, where a retail investor can only do 1x. And so I haven't got to margin yet, but I'll explain, and it'll make more sense in a minute. Margin, in short, and I guess we'll just talk about it now. Probably would have made more sense if I organized these in a way where they all had a better correlative relationship in this discussion. But anyways, so margin as well as kind of leverage, they both sort of refer to borrowing money to do trades. It doesn't always have to be money per se, or it could be something of money, something of monetary value. But essentially, let's just keep it basic and say I have $1 as a retail investor. Robinhood, using Robinhood as an example, will give me $1, right? So now I have $2 to go invest with, right? $1 is not mine, but $1 is mine. So I always get my $1 back, maybe, assuming I don't lose everything. But I always owe Robinhood money, and so I always have to give that back to them before I can actually start to get my dollar back, right? So Robinhood has to get paid back before I get my money back. So now out of my $2, if I broke even and now I want my dollar back, I give Robinhood their dollar back. I get my dollar back. Now let's say I double my money. Well, I now have $4, right? I still only owe Robinhood $1, right? So they still get their $1 and I get my $3, right? So that's the sort of advantage to margin, but it's also dangerous because it can also cause you to lose more. And we'll explain that a little bit more. But there's also little things like a margin call. I probably should save this and keep this here. We'll even throw in maintenance so you can kind of understand what those two are. So we'll get to that in a moment. So an ETF is a fascinating thing. I believe that's exchange traded fund. So these are not. I mean, I can see some correlations between this and a hedge fund, but it's not really that. It is an institution, right? So they're generally institutional investors, but they're institutional investors that you can invest in, right? So it's somebody out there who is running a portfolio, who's running a bucket of positions, and there's a lot of different things those positions can be correlative of. You have ETFs that represent the value of gold. You have ETFs that represent the value of curated art, right? So the most common ones you'll find people generally investing in will be ETFs that represent an aspect of a market, right? So the most common ones you'll find in like retirement funds will be things like Vanguard, things like the SPY, DIA, the Russell 2000. So these are essentially funds that represent the index that they are traded on, right? And so these are really quite fascinating. So for example, if you wanted to invest into the Nasdaq's version of this, which I think that one's the Vanguard, what that does is that essentially you're essentially looking at a fund that is exactly weighted to represent the Nasdaq. So what I'm going to do is I'm actually going to bring this up over here on the other screen so we can get a little looky-see at this. So this right here is the Vanguard S&P. All right, so this one's actually S&P 500. I was incorrect. It's not Nasdaq. So if you were to look at this and look through the positions they actually have, which they show you the top 10, if you were to look at all of them, you would find the weight, in other words, the percentage of the fund that is held by Vanguard matches the actual S&P 500. So that would mean the amount of stocks they have, the amount of companies that they have, the amount of positions that they have should generally match the S&P 500. So that means when the S&P goes up a percent, this will go up a percent. When it goes down a percent, this will go down a percent. So what these do is these are very fascinating ones because these give you the opportunity to simply invest in the market at that level, at a super high level. So because of that, as you can see, they're quite expensive, right? They're not cheap. But you know, you when you buy one of these, you're in something that is super robust, already diversified by nature of what it is, because it has so many different things built into it. So they bought so many different things to represent the market. It's already kind of diversified. And so if you were to look at the max on this, you'll notice that this does only really one thing. It just goes up. And that's because the S&P 500, which is obviously a very robust index, has a lot of robust companies in it. Some obviously will go down, but in general, economies do what? They grow, right? So when you invest into what's known as a benchmark ETF like this, benchmark being one of those high levels, S&P 500, Dow Industrial, and the Nasdaq. Those are your benchmarks. Those are kind of what everyone sort of looks at and says, okay, well, these are the things that will always perform well or should perform well or are a representation of the economy, right? Could be, maybe this is a representation of the global economy, the United States economy, or whatever, right? So they may say, well, the Nasdaq's a little heavier on tech, so maybe the Nasdaq's a better representation of the tech health, and the bottom line is these are good baselines to sort of look at and say, okay, well, here's my portfolio. How am I comparing against the markets, right? How am I doing against everyone else? And I don't necessarily mean everyone else as just individual retail or institutional investors. I just simply mean how am I doing at the potential of if I was to buy into an ETF and just do it that way, which is why you find so many retirement funds and sort of safe investment funds do go heavy on these. So, like if you were to invest, for instance, on Acorns, which is sort of a automated managed portfolio, it really doesn't do much. There might be occasional modifications of the portfolio there, but for the most part, something like Acorns stays pretty static. It doesn't really go anywhere. It just, you know, it locks you into to it kind of pools your money with other people's money, and it goes and it buys these ETFs and other funds, which is why Acorns is kind of a cool platform because it does allow them to do again some more back end magic with the money, which allows them to buy things that you otherwise wouldn't be able to buy. So as you can see, $550 just for one share of Vanguard's expensive. So what they'll do is you'll actually probably get like $100 worth of Vanguard, but what they'll do is they'll wait till you and several other people have added enough money to your Acorns that they now have enough to go buy a piece, buy a single Vanguard, and you now get the amount of Vanguard respective to what you contributed to that, right? So if you spent $550 gets you a Vanguard stock, and you put $100, well, now you got approximately 1/5 of that stock in your Acorns account. I believe Robinhood does allow something like that as well, but you're taking a little bit more direct control of that, where you will do the fractional buys. Um, it's handy. Again, this is all kind of newer stuff. Obviously, if you go back to the 90s and the early 2000s, this stuff wasn't so common. It was actually very expensive to do any kind of trading because they had trading fees. And then also they generally didn't allow you to do like fractional stuff. And it's just they've found ways to do weird stuff with money to allow them to make things more accessible to the average retail investor, which is nice. For sure, because obviously now it means you don't need to necessarily give your money to a broker and pay someone to do your trading for you. You can kind of do it yourself because things are more accessible. The very fact that I have this right here sort of proves that. One thing that's really cool is when the markets are actually open and you flip this over to one day, and then you actually, you could even drill into the advanced, but if you get into even the one day, I believe you can set your ticks, and it's actually pretty fast. Where if you considered back in like the 90s, if you didn't really have like a Bloomberg terminal, if you weren't really tapped into the New York Stock Exchange, you were finding information out pretty delayed. I remember when I first got introduced to stocks. I think I was in seventh grade. We started learning about them basically, and the way that worked is it was every morning when we got the newspaper. That's when we found out where it was at, right? Like you didn't have any, unless you were watching, some sort of money news channel, right? Studying either Bloomberg TV or something like that all day long. The only way you knew what something was doing was the next day when the newspaper came out. I'd tell you what your stock did at closing bell, and that's how most retail investors back then would have operated, right? And that's wild if you think about it, because it meant you couldn't do anything for at least 24 hours, right? You didn't know what was going on with your position. And then if you didn't like something, if you didn't like where it was going, or you wanted to make a change to your portfolio, you had to call somebody and tell them what you wanted to do, and that they would, they'd go off and they'd do it. And so that the delays there were quite phenomenal compared to what's going on now. Just 20 years later, you got uh, probably more accurate information than they were getting on Bloomberg terminals in the 90s. I mean, the only thing I think that gets better than really what you can do nowadays just on your cell phone or on any run-of-the-mill computer would be to actually be on the stock exchange. Now, I think that the modern Bloomberg terminals are probably extremely fast, but it's unnecessary for the average retail investor to need faster than what's offered by today's system. So that's a great time, to be an investor compared to 20 years ago, where things were a lot more opaque and uncertain as to what was going on. So, anyways, that one's kind of long-winded. There's so much to talk about with ETFs. I could go on forever, but anyways, we'll just roll on through. A short, that gets tossed around a lot. So short is just, just basically speaking, it means that you're going to take a position where you believe a stock is going to go down in value. So how do you say when something goes down in value? Well, they like to use the word bearish, right? So or bearish, right? So that just means going down, right? So that's very simple. Going down, down. And bull means going up, right? So that's why you oftentimes will see like bull, the bull outside the New York Stock Exchange, because obviously the general idea is you want the market to always go up, right? Or at least that's the theory. At a very basic level, that's true, and it will make you a little bit of money for sure. Anytime something goes up, you'll make some money, but the old saying is fortunes are made in bear markets, and we can get into that. It's much more complex. The more simplest stuff is just be a bull, and that's where most people are at, and it's never a terrible way to be if you just want a secured, guaranteed investment gain. Leverage and margin we sort of talked about. That's just borrowing either money. You can also borrow stocks. You can also borrow contracts. There's a lot of things in the investing world that you can borrow or buy beyond just the stock. So when you hear, and I probably should add that here, derivatives, probably did I spell that right? All right, cool. Um, Derivatives, I mean, as the word implies, it's derived from. That means it is something that essentially is a piece of or an iteration of something, right? So if I take a if I have a peanut butter and jelly sandwich and I then make I don't know if anyone remembers these things were awful, but in the 90s there were gumballs that were peanut butter and jelly sandwich gumballs, right? So the gumball is a derivative of a peanut butter and jelly sandwich, right? So I took something that isn't that, right? A gumball isn't a sandwich, but it's essentially like that. It's inspired by, it's like a piece of that. It's the structure of that represented in something else. So a lot of things that we'll talk about are derivatives. So we need to kind of know what that word is, and I'll kind of break it down a little bit more simpler to keep things smooth and running. But all three of these are kind of within the same sort of wheelhouse. Stocklend. These are programs where you lend out your stocks, which have a lot to do with shorting. And other weird investment strategies. But in short, when you buy a stock, it's yours, right? You own it, but you can lend it out for a variety of different uses. Now that's usually automatically done by the platform you're in. E-Trades does it. Robinhood does it. I'm sure other ones do, like TD, whatever the hell is the house. I don't even know. Anyways, wash sales aren't something you really need to worry about too much with Robinhood. Again, they run they run magic to sort of make it so you don't have to really think too much on it. But a wash sale, it really has to do with taxing, and selling things at a loss, which play into your realized gains. And I really should organize this better. So realized gains. All right, let me get a drink real quick. So realized gains. So did I switch this back? No, I did not. I am an idiot. My bad. Anyways, so we don't want to see that anymore. We don't want to see this. Uh, all right. So realized gains. Realized gains are so when your portfolio is performing throughout the day. Some things now are 24 hours. Especially like take something like a crypto, for instance, right? If you bought, let's just say for argument's sake, you bought a Bitcoin worth 50 grand at the time you bought it. It's now worth 75. You have made 25 grand, right? But until you sell that Bitcoin and get your 75 grand, you really didn't, right? You have arguably made that money. Like that's what it's worth. But until you've actually sold it, until someone has bought that Bitcoin off you, it's still it's unrealized. It's not really your money, right? Like you don't have that money in your hand. So when you sell something for either a loss or a gain, it becomes locked in, right? You're not you're out of the game, so to speak, right? So now my Bitcoin is sold for 75 grand. I now have $25,000 of realized gains. Um, and so that's very important because that's where the term, you always hear capital gains, capital losses in terms of tax conversations that legislators and regulators and lawmakers will talk about. Well, what they're talking about is that, right? They're talking about that $25,000 that you just made. You just made 25 grand. That is not part of your income. It's not, well, it is part of your income, but it's not part of your salary, right? It's not part of a job. It's not, you know, you made this based upon investing. You essentially went out and did legal gambling, and you won 25 grand, or you lost 25 grand. And this has a lot to do with the tax code and how taxes behave. And this stuff becomes very important um, because you could really damage your gains based upon your tax behavior, the things that you've done with your portfolio as it relates to taxes. And again, we'll get more into this. Almost each one of these needs its own part because these things are kind of complex. I'm going to try to keep them as simple as possible. I can't promise I'm going to be very effective at it at all times, but in general, yeah, it just has a lot to do with taxes and the way that's the way that Uncle Scam, as I knew somebody would used to call him, operates with some of these sort of things, and how it sees it is it's not until it's actually realized, not until it's locked in. So this allows behavior to occur. Uh, so for instance, and I'm trying to remember who I think it was Kamala that mentioned it when she was running for president, and I thought this terrified me. But they were thinking about doing taxation on capital gains and losses that were unrealized, and the reason that they were talking about that is, well, let's imagine you had, you know, $50 million, right, in a portfolio, and it keeps going up every year. You're making a half million to a million, right? Just slow and steady, just making that kind of money. But you never realize it, right? You never sell your positions. You just keep doing that. And essentially, you end up creating all this wealth. Now, you never tap into it, right? Like it's locked, right? Like you never get to it. And you can give that money to your family. You can, somebody can inherit this stuff. You can um, do things based upon it, right? Because even though that stuff's not realized, you can't withdraw the cash. It still has some value, and you can do things with that. There's, getting back into stock lending or other things that you can do that are derivative of your portfolio that allows you to essentially leverage your own portfolio's value to create money outside the normal realm of the capital gains and losses realization. And that is some of the stuff that mega rich people, right? And you don't have to necessarily be mega rich. You just have to have somebody who is an accountant or somebody that knows how to work these sort of things. And it essentially allows you to do, sadly, legal tax evasion, right? It allows you to create wealth that is derived from your portfolio without ever realizing those gains or losses, and therefore you don't have to pay taxes on it or pay taxes on them at the same rate that you would otherwise be required to. So it is fascinating. It is interesting how a lot of that works, and a lot of it is just comes down to that. Is what you'll find is a lot of the more advanced, interesting, and investing stuff is simply just derivatives, right? It's just taking something and just manipulating it and making it fit into a different category, a different plan, a different program, a different strategy, and getting away from the drawbacks that those more normal strategies have, those core strategies have. And taxes is a big one. Taxes will, I'm gonna be having a rough year this year. I'm terrified. But a good like example of a tax strategy is I'm not. I just bought a truck and I need to liquidate a few things to sort of move some money around, and I'm waiting until after the first to do any of that because I don't want to realize and create any liquidity in this year because it's already going to be such a heavy year for me. So I've already realized. I think I've realized around 90 to 80,000. Um, yeah, somewhere like 80 to 90,000. I've realized this year, and so I have to pay taxes on that. And I already have a fairly high income from my normal job, so it's like my tax bracket's already high, and so now I got an extra 100 grand that I'm probably going to have to pay taxes on that hasn't had taxes paid on it. But so let's just say argumentally that my tax bracket's 30%. That's 30 grand I'm going to have to pay. So it's like I don't want to flush anything out right now, especially when I can just wait a week until something is in a better position to begin with, and it'll roll over to tax year 2025. I haven't looked at the brackets to see if I like those brackets better, but these are the things you kind of want to start paying attention to, right? It's like, what is your tax bracket for the year going to be? Is this the year that you should make a bunch of sales, right? Should you realize things, lock it in because this is a year for a variety of reasons that maybe it makes more sense. It's more strategic for you to do your sales this year versus last year or maybe the next year. Um, but that's the sort of magic of realized versus unrealized. Is it just when something's unrealized, it's kind of floating. The money technically exists. You obviously can't access it until you realize it, but it allows you to skirt policies and a lot of different things, and allows you to be more strategic about how you manage when you sell. Because when you sell is just as important as what you're selling. And again, we'll talk a little bit more about that. So the next thing is a RIT. So what's a RIT? A RIT is a real estate investment trust. I bring this up because this is a big part of my current strategy. They're basically ETFs, but they're ETFs that fall under very special tax classification. Their tax classification, in order for them to receive the tax benefits that they get, they have to actually pay out 90% of their profits to shareholders. So what that means is these have the highest dividends in general of anything that you'll find. Um, so again, depending on your strategy, and I'll talk a bit about my strategy in a future video. But in short, my strategy is I simply just want passive income, right? Like I want to get to the point where I'm making X amount of dollars every month. Doesn't matter, I'm making this. Now, that again gets back into the realized versus unrealized gains. Well, if I'm buying, let's just say I have 100 grand on a particular RIT. Well, if that RIT goes up 2%, I lose 2%, or I gain 2%. If it goes down, I lose 2%. But I generally don't care about its behavior because I'm not probably going to sell these, right? Unless I need to. Like I said, I need to liquidate some right now because I need some liquidity for this purchase I just made. But in general, I lock in, I stay there, and I have no plans to move off it. So it's going to stay unrealized. Losses, gains, I don't care. They're going to stay unrealized because I'm sort of banking in on the dividends that come from RITs. And I'll show you what some of that looks like. Some of them are just absolutely juicy, and I like it. That's my particular investment strategy currently, and I'll get into it a little bit more. Security is essentially what we're talking about. It doesn't have to be a stock. It doesn't have to be an ETF. It could be a crypto token. It could be technically an NFT. Anything that falls under the security regulations by the SEC, right? So Security Exchange Commissions. Um, that's essentially a security. So that's a pretty broad umbrella term. Could mean a lot of things. Could be a little bit of things. Whatever. Crypto tokens, it's a type of security that is, the intention is for it to be a derivative of fiat currency, and I suppose I should mention what fiat currency is.
So I'm not going to write it down, but fiat currency just basically means your more standard currency, right? So like a US dollar, right? That's a fiat currency. It doesn't have to be that, right? It could be a yuan, could be yen, could be pesos, doesn't matter. But it's, those are fiat currencies are essentially currencies that, going back to originally how these things were sort of designed, is they're derivatives of material wealth, right? They're derivatives really usually of gold and what uh, the companies. Well, that used to be what they'd call the gold standard. It's not necessarily that anymore. Now it's more the global acceptance, the confidence in it. So, like the U.S. dollar has a lot of confidence, right? Like a lot of places you go accept a U.S. dollar. Not a lot of places you go will accept a yuan or a peso, right? So the amount of confidence really in something represents its value. Crypto tokens are essentially trying to subvert that and replace that. Sorry, my mouth just gets so dry from my medication. Um, and so there's a lot of them out there. Most of them are noise. Most of them are goofy, and they're quite honestly they're just attempts at fraud. And we can talk about some of them. Cryptos are extraordinarily volatile, primarily because it's still fairly new, even though they've been around for a little bit now. I mean, Bitcoin um, is what, about 15 plus years or so. I think it's about 15. Yeah, about that around. I mean, Bitcoin's been out there for a minute, but the concept is still generally new, right? There's not a ton of regulation around it. There's not a lot of education and knowledge about how they work, what's their purpose, and there's so many of them out there that it's a landscape that is ripe for fraud and bad actors to take advantage of the uneducated. So because of that, there is volatility that's derived from that, and I can't believe I don't have volatility on here. I know I have it down here that I want to talk about, but volatility just basically means so if you take a U.S. dollar for example, and you were to look up a U.S. dollar, right? The U.S. dollar does go up in value, does go down in value, but generally speaking, it's not massive, right? Like if you go to bed one day and you wake up the next day, the dollar isn't worth $2. It isn't suddenly worth half a dollar, right? There's that would be like an extreme level of volatility if you have something that suddenly can double overnight or lose half its value overnight, right? Like that would be a very volatile thing. There's a lot of things out there that make money off volatility. There's literally ETFs and funds designed specifically around capitalizing off of volatility and making money off it. Whether it be the confidence that volatility is going to go up or confidence that volatility is not going to go up. On a lot of different things, volatility in the market, volatility on position, volatility on volatility. It gets kind of goofy with the ways that you can manipulate the sort of volatility of something. But again, volatility basically just means the speed in which something or the frequency in which something goes up or down in value. It's not particularly stable. It can be very drastic in its changes, and the amount that happens relative to the security or the position's core value is its volatility. Cryptos are extraordinarily volatile by nature of what they are, extraordinarily, which is why some people have made a ton of money off them, but most people have probably lost money off them. They're extraordinarily scary. Don't recommend messing with them if you can get away from it. I have made a good amount of money off cryptos, sure, um, but to me, it's probably been one of the bigger gambles that I've ever done. There isn't a ton of solid education and research that you can do to back it up because a lot of positions you can look at something and get a general idea like, okay, what is the fundamentals of this business, how's it doing, what's its business model, who runs the business, how much confidence do I have in that person. So take Disney for instance, right? There was they brought back their old CEO, Bob Iger, whatever. Anyways, one Bob replaced the other Bob. There was two Bobs, and you the prior CEO wasn't doing great stuff, right? Like he was getting into fights with Ron DeSantis in Florida, which caused them to lose their special tax and self-administration status for Disney World and all this other stuff, right? So they get these controversies that happen. So that stuff ends up in the news, right? You can look at that and say, okay, is this company going to course correct from this problem, or are they not? Are they going to lean into the problems? What's going on? Who's running the company? All right, well, this Bob now runs it, and that Bob doesn't run it. And you can start to look at this and say, okay, I think this position is going to do better or do worse based upon their internal organization, uh, legislation that's coming down, regulation, and all these things will have an impact on the volatility of a particular position. Um, Crypto, on the other hand, gets really tricky because there isn't a ton of that, right? It's very rare that you will see some kind of news that will stabilize the market of cryptos. It generally goes the other direction, right? And there, the very fact that you can create a lot of these cryptos, right, without a ton of oversight, right? Like if someone that knows how to code crypto can sort of just go do it. Um, and then even outside of the coding aspect, you can learn to mine it, right? You know these things are made to essentially decentralize the minting, right? So in the past, you only had certain people that were allowed to make currency, right? Fiat currencies generally are only created by certain people. They have a lot of security controls around it to sort of make sure you're not uh, creating counterfeit dollars and what have you. So there's this network, this sort of distribution system that is set up to back fiat currency. The whole point of crypto is it doesn't have that. So where that's a benefit, that's also a pain, right? So now suddenly you can just solve these very complex math problems with a computer. Obviously, this is a very general simplification, but you solve a simple math problem with your computer solves it, and once it's done solving it, it produces a token for a particular crypto flavor. Um, and now you have it, and it's a legitimate token. You can trade it on the blockchain, and it has some sort of monetary value. Most of the tokens are worth damn near close to nothing, right? And where it gets ironic is a lot of these tokens, again, that math problem has to be solved by a computer. The computer has to draw electricity to do that. It usually costs more in electricity than a lot of these tokens are worth. So it's like, it's just a goofy system. And I think the dust hasn't settled on it. I think once the dust settles on it, we'll see, is this sort of stuff going to stick around or not? My theory on it is no, and or I think it could stick around. I just don't think it'll ever be as successful as people want it to be. Because here's the thing: if it does become successful, that's when it will get shut down, right? Because fiat currency is the world order. It's the way the world works. It's the way things are organized. The only way cryptos, in my opinion, can supplant fiat is if they literally do that. If the people that control, manage, and have those networks that I was talking about for the creation and the management and the oversight of fiat currency can migrate that over to cryptos and have a crypto version of that, which they kind of do. There is a U.S. coin now that like represents a U.S. dollar. It's worth as much as a U.S. dollar. Seems to always be locked into that. So whatever the dollar is worth, you can just go have a coin version of that. Um, but is it do we think we're ever going to live in a world where a Bitcoin is going to replace a dollar? No. While there are places where you can do transactions with Bitcoins, well, first off, Bitcoins now are worth significantly more than dollars, right? And there's also significantly less, which is why they're worth so much, right? Like there's far more dollars in the world than there are Bitcoins. And Bitcoins have a finite amount, right? I don't know if they've hit it yet, but eventually they're going to mine the last Bitcoin, and that's it, right? Like then the amount that are in there is the amount that's out there. And as these Bitcoins are either lost, destroyed, whatever the case is, it's going to drive up the value of the Bitcoin even more because there's going to be even less. And then eventually it's going to be derivatives or fractions of the Bitcoin that's going to represent the Bitcoin's value. And it's going to get messy and it's going to get confusing. And it's just going to be like, well, now we're just creating multiple layers of the same thing to represent the same thing. And so that's one problem that I don't think that, there's really been talked about how they're going to address that. The energy use of them, again, don't know how they're going to address that. And then ultimately, just the political challenging power of cryptos. Once they come up and they start challenging fiat currency, tit for tat, I think you're going to see more and more countries outlawed. I've said this for years. After they found out North Korea was sort of using Bitcoin to circumvent a lot of uh, sanctions, right? Economic sanctions that were impressed upon them. Some countries had started outlawing Bitcoin, right? And I think that's a real problem. There's a reason why Bitcoin's used by bad actors and criminals due to its untraceability. Because it is so decentralized, because you can do a lot of squirrely stuff with it. It's a lot easier to use that in a dirty way compared to dirty money, which obviously that's why money laundering exists, right? I'm not even sure if you need to launder Bitcoin. I think if you can just make Bitcoin a little bit untraceable, then suddenly no, why do you need to launder it now? Now you don't have to, prove that it's dirty or clean money. It's just a Bitcoin, right? And they can't backtrace it to where it came from, so it's effectively clean money now at that point, and that's a dangerous position to be in, right? It just gives a lot of bad actors a solid channel to do squirrely shit. Um, but they do that on the blockchain. The blockchain, just in short, is just the network or the platform, the technology that's used to track and to transfer cryptos and to keep transparency and security and all these sort of things. It's just essentially like a financial network, if you will, that's dedicated for things like cryptos. A clearinghouse is the people that are responsible for clearing your purchases, whether it be a sell or a buy, whatever it is. So, for instance, Robinhood is a clearinghouse. E-Trades is a clearinghouse. Oftentimes, these clearinghouses sit in front of something else, whether it be a bank or a financial institution. So, I believe Robinhood sits in front of Citadel, which is a hedge fund. Probably also offers financial services. Um, their main job is to make sure laws are followed and to process the transactions for sales. They make their money off of fees, a lot less than it used to be. I remember when I first tried trading back in like 2011, I think I was paying $40 for a trade. So that meant $80 to do a buy and a sell, right? So that meant no matter what I did, I had to make at least $80, right? So if I bought one stock and that stock was worth $10, I'm I got a problem now because now I'm already negative, $70 right off the back, right? And so now that stock has to, make up that difference. It has to pretty much 8x for me to make any kind of profit, and that was an ugly situation. They've obviously fixed a lot of that now, so now it's pennies compared to what it used to be, and you pretty much don't even notice it, right? Like they're still making it. I'm not really quite sure how all that works. They're still somehow producing fees based upon these purchases. I'm not really quite sure how they're doing it, but that's that. Capital liquidity, pretty straightforward. That just basically means cash, liquid cash. Um, because obviously these things again are derivatives. Everything that you can purchase with cash is essentially a derivative of cash, right? So I've been sitting here drinking this Dr. Pepper Zero, and this Dr. Pepper Zero is a derivative of cash. It's a very small derivative, right? Maybe what, like 60 cents? But it is 60 cents. So I have a 60 cent. I could argue that this Dr. Pepper can with full soda is worth 60 cents, right? It's a 60-cent derivative of cash. And that's just how all this stuff sort of works, right? It's representative of cash. We're turning that cash into a product. Um, so when it's not a product, when it's not a position, when it's not anything, when it's in its true form, its final form, it is in capital or liquidity. And that is important because again, this Dr. Pepper, let's say you don't like Dr. Pepper. So now that Dr. Pepper isn't worth 60 cents to you. Hell, it ain't worth anything. You don't even want it. I couldn't even give it to you, right? Well, I can always give you 60 cents, right? You'll always accept cash. So, well, you should. Otherwise, it'd be pretty weird if you didn't. So, the thing is about capital liquidity is when the money is in that state, when it's in that form, it can now be accepted in a lot of applications. Now, you can use a stock like it's cash, right? Like if I have a stock that's worth $1, I can essentially use it like $1. It doesn't mean everyone's going to accept that. Doesn't mean everyone's going to be down for that. But it is technically $1, right? It represents $1. And so that's where you get into a lot of these weird derivative stuff. Again, trading, futures, things like that, contracts, and we'll talk about it a little bit. There's a couple quick points. I'm going to wrap this up because, as you can probably hear, I'm starting to fade, get a little, well, med's starting to hit me a little bit after a while. So it's just a couple quick things that I want to talk about in this to wrap this up. Mental state. First off, when it comes down to investing, if you're in love with your money, then you probably shouldn't invest, right? You just probably shouldn't. I'll be honest with you. Um, I think the most important thing to investing isn't analysis. It isn't liquidity. It isn't any of that. It is simply being in the right emotional state. If you're in the wrong emotional state, you will make decisions. You will do things. You will buy positions. You will sell positions. You will panic. You will do things that simply are not conducive to making money and being successful in investing. This is something Warren Buffett swears by. He's one of the greatest investors of our time, and I firmly agree with it. Right? If you don't have patience, if you don't have a sort of clinical objective approach to investing, if you sit there and you log in and you see you've lost money and that upsets you and that's going to mess with you and make you make decisions in the moment that you're upset, then yeah, you shouldn't be doing this because you have to divorce yourself from the money. You just have to, right? It has to simply be the way I look at it, because I've played a lot of video games. You have to kind of look at your real life money almost like video game money, right? When you're in a video game, yeah, you have some attachment to that money. You worked for that money, but it's not the same as real money, right? So you're over there making purchases, you're doing things, you're maybe manipulating in-game economies with in-game currency, and you're doing it in a way that is not exactly going to go jump off a bridge if you lost a significant amount of in-game money, right? It's not the end of the world. So kind of the same thing. That's kind of where you want your mindset to be. You don't want to be married to and in love with your money and really, really get tilted or emotionally destabilized based upon the performance of your money. It also goes the other way. You don't want to get super excited and start thinking goofy things because you're doing great. Because then you can run into a situation where maybe you start making decisions because you think, oh, I'm making all this money, I'm going to be rich overnight, yada, 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 and then you do something stupid. A good example of this is Boogie2988, if you've ever followed his crypto nonsense. The guy makes one video talking about how he's rich now and he's sort of pissing in the wind, talking about how great he is, and then he turns on and loses all of his money, literally the next minute in crypto. So kind of volatility, not a good idea. But the bottom line is he made decisions. In his case, he makes videos, right? So his videos locked in his win, right? He broadcasted something to the world based upon something that was an unrealized gain. He didn't actually have that money yet. He probably shouldn't have been saying or doing anything. He probably should have just kept cool and not thought too much about it. Worry about, feel a certain kind of way about it when that money's in the bank. And even then, maybe not until you've actually spent it, right? Because again, a $60,000 truck is a derivative of 60 grand. Until you've actually made that purchase with that 60 grand, you can't drive 60 grand, right? It's just numbers in a bank account. That's the way that you need to feel about it, right? Be excited when you have that vehicle, right? Be excited when you have that house because you've now got that. When it's still numbers in a bank account, when it's numbers on a portfolio, treat it as such. Don't lean into irrational, emotional instability. It's just not. It's not helpful in any way, shape, or form for investing. It's quite the opposite. Doesn't matter, positive or negative. It will hurt you. These other two things we've talked about, and then so the last thing I'm just going to kind of close with is be very cautious about looking at ratings. Whether it's a buy or sell rating or analysts and what they're saying. I'm not a firm believer in these at all. Sorry. And the reason for that is I have watched Alibaba is a great example. I lost a lot of money on Alibaba back in like 2022, I think, maybe 2023. I don't remember. It had to be like 2021, 2022. Anyways, I watched Alibaba, I think, go from $360 per share down to like 160, right? Lost pretty much two-thirds of its value due to Chinese regulators coming in and causing a headache for them, and they got kind of wrapped up in controversies, and so um, they tanked. And I bought into them because I did listen to analysts and ratings, right? And the rating was a buy. Pretty much everyone was saying buy it. Everyone was saying, oh, this thing has like a price point, probably about $50 or $60 a share higher than it currently was. And so it was like, oh man, you looked at it, you saw that it constantly was going up, and you thought to yourself, man, that this is a guaranteed win. This is printing money. Let me buy this, right? And so I bought quite a bit of it, and then I lost a ton of money because lost about two-thirds. And the thing that I've noticed is one. Throughout this entire process, because this wasn't an overnight thing, right? This happened over almost over a year. And that entire time in the year, no one changed their rating. They all continued to say buy, right? And the analysts continued to be bullish on it, right? Almost none of them ever switched and said they were bearish, which is wild to me. And the reason that they do that is because the core reason that they said, oh, you should buy this at, let's say, 360 a share, was even more true at 160 a share because now it's cheaper, right? So in their mindset, the very reason that they're telling you to buy it hasn't changed. But the truth is if you've listened to them at any of this at any point in that window, like I did, you would lose a significant amount of money. And that's where you sort of realize that these don't mean shit, right? They don't mean shit for a few reasons. One, what I just explained, you can sit there and watch a stock absolutely tank, and they dig their heels in and they don't change. They say, oh, no, I still feel the way I feel. Okay, but it's losing tons of money. You're not going to factor in this new bit of information. Nope, I still feel the way I feel. Okay, that's crazy. But then the other thing is like there's not consensus, right? You can get 500 analysts in a room and 499 say buy and one say sell. Well, what do you do now, right? Like, okay, well, I'm clearly going to go with the buy because that one guy that said sell was wrong. But then turns out the sell guy was right and the 499 were wrong. So what are we doing here? Like, when they're saying, when you're looking at a platform like Robinhood and they're saying, we're recommending a buy or a sell, who's this based off of, right? Like, you got to look into those analysts. You got to look at their track records. And oftentimes the track records are not great anyways, right? And even if the track records were good, it's like, yeah, broken clock is right twice a day, right? So it's like, is that, I mean, you're now putting a money on someone else's, um, someone else's advice. And the thing is that person probably doesn't have to live with the consequences of your decisions, right? You do. And I've always been big about that since my early 20s. I remember I used to tell people, well, there's ridiculous advice out there. I can give you ridiculous advice that will do the thing that you're looking for. If you want a six pack, I could tell you, yeah, do 5,000 crunches a day every day, and you'll get a six pack. That isn't wrong. It is technically true. It's extreme. It's not efficient advice. It's not tailored advice. And at the end of the day, I don't have to live with that advice, right? I'm not the one doing the 5,000 crunches a day. I'm not the one living that way. You are. And if you decide to take my advice, you got to now take that to the bank, and you have to execute on that and deal with the consequences of it. I feel like that's big when it comes to everything. It comes to relationships. That comes to professional stuff. I'm always very dubious and second guessing anyone that gives me advice when they themselves don't have to deal with the consequences of that advice, and especially if they're not buying what they're selling, right? If you're looking at an analyst and they're making recommendations on a stock and they themselves are not personally invested in that stock, making those same choices with their portfolio, then yeah, stay away from them. It's just goofy, and like that's Jim Cramer, the guy that's like on Mad Money, and he's always spouting off. I mean, I've taken a couple of his advice, and I paid for it, right? Like I've lost money. The guy has a lot more money than I do, so like he can lose money off this sort of stuff at a greater fault tolerance than I can, and you know that's something you have to evaluate into. Like, what is the financial health of the person that's giving you this advice? If they're far wealthier than you, do you really want to listen to advice where if it tanks, they barely notice it, but if it tanks for you, you're in the poorhouse? Maybe not. Maybe not. So these are things you need to factor in when you're dealing with this sort of stuff. Is your fault tolerance, your emotional IQ, and be very, very careful about accepting advice, including any advice that I may or may not give during my videos. And I'm not trying to give advice. I'm just speaking out loud and just sharing my thoughts on it. So, take it for what it will. Anyways, I'm going to end it there. Later.